On the 10th of March, just under 4 weeks ago, the Silicon Valley Bank in the United States collapsed. This was the second largest bank collapse in US history, and it was rapidly followed by the collapse of a related crypto bank called Signature and then a smaller bank called First Republic. The bank run which produced this collapse then spread to Europe, where Credit Suisse, which is the second largest Swiss bank, and a bank notoriously boring in days long gone, also collapsed after the Saudi National Bank refused to recapitalise it on the basis of the bank run. And then the panic turned to Deutsche Bank, which is the largest bank in Germany, although that so far has survived. Now, Joe Biden, the President of the United States, Janet Yellen, the Chair of the Federal Reserve, and Christine Lagarde, the head of the European Central Bank, all rushed to say that the system was basically sound, not to worry, don't panic. Which I think was a bit like the board of directors of Chelsea Football Club, people that they had confidence in Graham Potter. We know what happened there. Now, just how vulnerable is the banking system and the world economy? Before I get onto that, I want to say something a little bit more general about the system under which we live, so we get an understanding of what role the financial system plays in the system. Now, we live in a system called capitalism. It's a system characterised, I think, by three fundamental divisions, or, as we like to say in Marxist circles, contradictions. The first is between capital and labour, between the ruling class and the working class, between those who profit from the system and those who are exploited in order to provide profits for that minority who constitute the ruling class. The second is within the ruling class itself. There's a ruthless competition going on all the time between the bosses themselves, trying to do down their competitors, to get bigger profits, to prevent themselves going bust and to take over others, and that forces them to reinvest some of their profits into the system in order to raise productivity, in order to get that advantage over others. And that makes the system dynamic, certainly relative to previous kinds of class society, but it also plunges it back into crisis from time to time as profits fall and businesses go bankrupt. But there is a third division that is very important for us to understand, and that is between the process of production itself and the process of consumption. These two things are separated. And of course, because they're separated, there is the ever-present possibility of crisis, because what is produced may not be consumed, may not be bought. Now, in order to make a system separated, where production is separated from consumption work, you need money. Money literally makes the world go round. A universal equivalent, as Marx called it, in order to ensure that what is produced can be bought and consumed, whether that's in terms of things that you want to buy in order to make other things, or things you want to buy in order simply to consume them. But once you have money, which is integral to the capitalist system, you have to have a financial system. It's inevitable. You have to have a place where people put the money they're not using at the moment in terms of deposits, and places where you go to borrow money when you have some purpose that you want for that money, but you don't actually have the money in your hands at this very moment. And from its very inception, the capitalist system was therefore, through the financial system, prone to crises. When people lost confidence in a bank, they take their deposits out, and then the bank would be in trouble, because banks typically borrow short. They get your deposits in, but you can take your deposits out on demand, but they lend long to people who can't pay back immediately, who have to build up the cash in order that they can pay back that money. So if suddenly money moves out of the bank, what does the bank do? Unless it can find other sources of money, it's going to go bankrupt. It has to close its doors, as they used to do in the old days. Now, this is essentially what happened to Silicon Valley Bank. Suddenly its depositors decided they didn't think the bank was terribly sound, but they also thought there were places where they could get a higher return if they shifted their money elsewhere. And when Silicon Valley Bank came to try and find the money in order to meet those deposit demands, they found all their cash was tied up in what are called long bonds. Anyway, government bonds of 3 to 5 years duration. They invested in these things because these government bonds were paying higher interest than the short-term government bonds because interest rates have been so low. But now interest rates were rising. So people who deposited their money in the Silicon Valley Bank could put them into other vehicles with higher interest, but the Silicon Valley Bank couldn't sell its bonds because now those bonds had lost value. Because if you have an interest rate of a certain level on a bond that's due to mature in 3 to 5 years, but you can get higher interest elsewhere, the value of that bond has to fall, and has to fall substantially until you find someone who's prepared to buy in order to make the profit out of buying that bond, which is offering a lower rate of interest than elsewhere. That's why the value of those bonds fell, and it's why if the Silicon Valley Bank had sold those bonds, it would have registered a huge loss on its investment, and that would have caused it to go bankrupt. Anyway, it collapsed here when it was taken over by the Federal Deposit Insurance Corporation, as they say. Now, the ever-present possibility of bank runs within the capitalist system was actually addressed well over 100 years ago, in the early part of the 20th century, when deposit insurance in one form or another, the different forms it took, was brought in order to reassure depositors that whatever the state of the bank that they had their money in, maybe it had unwisely invested the money, maybe it had extended loans that had gone bad, maybe it didn't have the cash. Ultimately, they would get their money back one way or another. And indeed, that's why central banks came into existence, to be lenders of last resort, to ensure that they had the cash guaranteed by the state, to bail out banks that had gone bad. In the United States, you had both that central bank doing that, but also a whole legislative process of deposit insurance, where if you had deposits up to a certain level, not huge, but maybe up to $250,000, you would be guaranteed by the state itself that you'd get your money back. So that was intended to stop those bank runs, because it was absolutely vital that if one bank went bust, it didn't spread through the system. Because if it did spread through the system, it would create the most terrible, catastrophic collapse of the capitalist system as a whole, which they were pretty keen to try to avoid. So why, though, is the financial system creaking now? If there's this Federal Reserve and the Bank of England and the European Central Bank and either implicit or explicit deposit insurance and so forth, why is the system creaking now? And the simple answer to that is inflation and the rising interest rates, which are the principal weapon being used by the Federal Reserve in particular, but other banks following suit, in order to combat inflation. Before I get into a little bit more detail on that, let me say something about the globalization of finance, which has been at the leading edge of the neoliberal ideology over the last 40 years and more. Now, the financial system, you know, by the way, that quite often you hear how important it is to regulate the financial system. That was the third element, if you like. If you had deposit insurance, you had a central bank lender of last resort to bail them out, but you had regulators to ensure that banks were adequately capitalized so that people wouldn't panic, and if they did start to withdraw their deposits, those deposits could be met by the reserves that the bank had built up. Now, the fact is that the system over the last 40 years ago has become very much deregulated and very much globalized. This has been driven both ideologically, on the basis that markets can do no wrong, and indeed more market the better, by the lobbying of financial institutions themselves, which are in competition with one another, always looking for ways to try and maximize their profits against their competitor banks and non-banks. That's a huge sector of financial mediation nowadays. And of course, that process safe in the knowledge that if anything did go wrong, they'd be bailed out by the state and ultimately by us, the taxpayer. But it was also accelerated structurally by the enormous growth in internationalization of trade and productive investment across borders. So a number of reasons why banking has become so globalized and relatively deregulated. Now, two consequences of this globalization and the relatively low rates of profit that have been prevailing in the productive sector of the major economies over the last 40 years has been a very large growth in debt, governmental, corporate, and personal. It's now much higher proportionately. The figures vary depending on who you look at, but somewhere between 2.5 to 3 times the levels of indebtedness that existed in the 1970s when we had the last great bout of inflation. So that's one feature of the globalization, huge growth in debt. Another feature of it is the growth of increasingly arcane forms of financial speculation, of ways of trying to squeeze out a bit more profit here and a bit more profit there for the banks themselves, and above all, for those masters of the universe who manipulate literally billions of dollars, trillions of dollars sometimes, every day of the week. Now, this is the context in which higher interest rates can be utterly lethal. Much debt and much investment over the last few years has been on the basis of very low interest rates, which followed as a matter of deliberate policy following the last great financial crisis in 2008. A 2008 financial crisis which almost brought the banking system down, by the way. Higher interest rates threaten the very possibility of those massive debts that exist across the world economy nowadays being paid off. Now, higher interest rates, of course, are intended to combat inflation. And they're intended to combat it by slowing down economies, by moving us towards recession, even if not into recession, and by squeezing the bosses who set the prices. Always remember that when you look at inflation, it's bosses that set the prices, not us, and also set wages, because it's also them who set the wages. So these interest rates are supposed to produce a situation in the European and the United States and elsewhere where there's a downward pressure on business to cut prices or to reduce the increase in prices and to cut wages, to make us pay for this inflationary crisis. However, I have to say this is a particularly stupid way of addressing an inflationary crisis, which is a product not of too much demand, of us having too much money, as if, but rather the product of a lack of supply, a lack of the production of the goods that we need in order to get by every day of the week. The aftermath of the 2008 financial crisis, after the banks were bailed out, of course, saw ultra-low interest rates and quantitative easing, that's to say the printing of money by central banks, as well as fiscal austerity, that's to say cuts in government spending and rising taxes on us. But there was only anemic growth, as I say, and the major economies seemed headed towards recession as the COVID lockdown struck. Now that lockdown of the major economies saw a boost to money printing again, and this time government spending, quite large amounts of government spending, to stop an even greater and longer lasting collapse in the production that lockdown brought about. But when lockdown eased off, 4 factors kicked in to mess up the production of goods across the world economy and precipitate the inflationary crisis that we're now experiencing. So let me just say something quickly about each of those. Firstly, there was the dislocation produced by COVID lockdown. Ships were in the wrong place, goods weren't being produced at the right level and so forth. Just, the whole process of trying to recover from that COVID lockdown proved much more difficult. And of course, there was a relative lack of workers, partly because of illness, long COVID and other things, and also the great retirement or resignation, as it called, as people thought, why am I doing this, when life could be really quite short and I could be doing something much nicer than this terrible job, which is so poorly paid, that I'm doing at the moment. So lack of workers, it's still there. There are still labour shortages across the European and United States major economies. Secondly, of course, there was the outbreak of war on the European landmass in Ukraine. A war which had a particularly bad impact on energy prices, which shot up because, who knew it, Russia was a major producer of oil, and they were cutting their oil production and the supply of gas to the European Union in particular, but for other reasons as well. Who knew that Ukraine was such a huge producer of rare metals that were vital in semiconductor production and so forth. So the Ukraine war itself not only sort of shook people up, but produced serious shortages of certain things which pushed prices up in vital areas. The third is climate crisis. Increasingly we're seeing shortages. Where this recently you can get tomatoes in the market, there wasn't lettuce and so forth. Many of these things now beginning to emerge are the product of the climate crisis. Climate crisis which produced, for example, produced a huge hike in grain prices before COVID kicked in because of the failure of the Canadian harvest in the face of a drought which was unprecedented in scale. So climate crisis is now severely impacting on production. And then fourthly, there's years of low investment in the productive sector. As I say, low levels of profit in the productive sector for the last 40 years. The levels of profitability haven't recovered to anything like they were in the so-called long boom of the 50s and 60s. And that low level of productive investment has made production in general much more vulnerable to the kinds of shocks we've experienced for other reasons, the previous three reasons recently, and less flexible actually in the face of significant shifts in demand, in consumption spending, which we've seen coming out of COVID. Now, in the face of a lack of supply, surely the sensible thing to do is to direct investment into those areas which require investment to meet justified demand. But central banks simply can't do that because it would require governments to take control of private industry and investment funds and direct them into those appropriate areas. So instead, central banks, it's pretty much the only thing they can do, was raise interest rates to cut both investment and consumption and direct us towards a recession. Now, we have a situation in which a tightrope is now being walked between combating inflation on the on the one hand, and precipitating a financial crisis on the other. A financial crisis which, incidentally, for all that they say that, the banks are capitalised, etc., could actually be worse than 2008. People who make these decisions look back at a chap called Paul Volcker. Volcker was the head of the Federal Reserve in 1979, 1981. There was high inflation back in those days in the 70s and towards it. And he hiked interest rates massively, much higher in real terms actually than they are today, and precipitated a very serious recession in the United States and in Britain in the 1980s, but he forced down inflation. These people are saying, how much Volcker is too much Volcker? And actually the record of central banks managing these things is pretty damn bad. So I think the tightrope is a very dangerous one indeed. Jamie Dimon, who is the head of JP Morgan, which is the largest bank in the world, he's been warning, by the way, that we're facing an economic hurricane, has been doing that actually since the middle of last year, and recently commented he couldn't quite understand why it was that the Federal Reserve, when they were doing their stress tests on American banks, hadn't worked out what the impact of higher interest rates might be on their viability and their fragility. It looks to me as though inflation is very well entrenched, that interest rates will remain high and probably go higher. That's all the mood music that we're getting. And that recession, and we don't know how bad, but a recession looms, that we're getting stagflation or worse. The current situation is that the Fed is still raising interest rates. And as I say, it's claiming higher capital requirements mean that banks, are sufficiently well capitalized to stop the crisis getting too bad. But interbank interest rates, that's to say the rates at which banks lend to each other, have risen very considerably in the wake of the crisis that erupted just some 4 weeks ago. And US regional banks currently have in their possession, they've invested in American bonds, US government bonds, where it's stated that there are now some $620 billion worth of losses if they sold those bonds off tomorrow. Now, of course, if they sold them off tomorrow, the losses would be even bigger, but that's another issue. It's just an indication of how vulnerable the system is in America, never mind anywhere else. The World Bank's projections for the next decade are extremely gloomy indeed. They are for a maximum 2.2% growth. Now, that's growth, but that includes all of the emerging economies, and it's way too optimistic anyway. It's difficult to say where the next points of vulnerability in the system, where the next points of crisis are going to break out, but I've got 6 quick suggestions, which I think, if I go slightly over my time, I'm just going to tell you about. First of all, the zombie companies. Somewhere between 15 and 25% of companies in the United States and in Britain currently, or rather until recently, were just about able to cover their debt repayments, but were making no effective profit. With rising interest rates, they're in trouble. So I think we're going to see much more trouble in that zombie company area, companies going broke. Real estate, heavily indebted in this country and in the United States. There's a corporation, it's the largest non-bank corporation, managing some $1 trillion worth of funds. There's an organisation called Blackstone. And they've been trying to sell real estate investment to people who've got some money recently, on the basis that the rising interest rates mean that there'll be less investment going into real estate, which means there'll be less real estate to be sold, which means the prices of real estate is going to go up, and therefore you should invest in this. And even so, $5 billion worth of money has been withdrawn, or at least they've tried to withdraw it from Blackstone, they haven't let them take it out. So that's a very vulnerable area. Commercial real estate, very vulnerable. Shopping malls half built and all the rest of it, heavily indebted. The value of commercial real estate in the United States is some 21% down at the moment. Fourthly, I didn't realise this until recently, the Japanese investors are the biggest holders of US bonds outside the United States. I thought it was the Chinese. It's actually the Japanese. And the reason for this is that Japan has had ultra low interest rates, and so Japanese investors could get better return on investing in US bonds. But now, Japanese interest rates have gone up, and there's a real fear that that money may be repatriated, and then US bonds go down, which means higher interest rates, and so forth. Fifthly, there may be a huge, how shall I say, contretemps in Congress, where recalcitrant, completely crazy Republicans decide not to allow the federal government to increase its debt levels, and therefore be able to bail out and to put money into the economy and so forth. That would be a major shock were that to happen. And then lastly, but by no means least, there are many other areas where this could happen. Developing and emerging economies are already, some of them are already in very serious trouble, many more could get into it. They have almost $100 trillion of external debt, dollar denominated, according to some estimates. Some put it low, but whatever it is, it's massive. And of course, there's a rising value of the dollar, so they have to generate more of their own currency to pay back, and rising interest rates on those dollar-denominated debts, so they have to pay more on top of the more that they've got to pay. And that's already plunged Sri Lanka and Zambia, just to take two examples, into very serious economic crisis, and there's going to be a lot more in the woodwork. The World Bank again. The global economy has experienced 4 waves of debt accumulation over the last 50 years. The first 3 ended with financial crises in many emerging and developing economies, and not only there, by the way. During the current wave, which started in 2010, the increase in debt in these economies has already been larger, faster, and more broad-based than in the previous 3 waves. So there's a lot of bad stuff coming there for the poorest people in the world. Now, inflation, I'm very pleased to say, has nonetheless provoked fight back. That's brilliant. And now is absolutely the best time to fight. Labour markets are tight. People aren't threatened by unemployment because you can get another job if everything goes bad. It's not that we can't fight back in a recession, by the way. Of course we can. But the terrain is more difficult. And if I were to bet on it, we're facing both a recession and continuing inflation, making the cost of living crisis worse over the next few months and few years, which is why it's absolutely ridiculous that trade union leaders with massive mandates to carry out strike action and win are selling their members short time and again. Just look at what's going to happen to the economy, comrade, whoever it is in the trade union leadership. Now, last 2 points very quickly. Financial markets themselves can seem daunting. Just look what they did to Truss and Kwarteng when Truss and Kwarteng, tried to challenge the prevailing financial orthodoxy from the right-wing position, not from the left. Never mind what they would have done to Jeremy Corbyn had he ever been elected. Financial markets both screw us when they lose confidence in us, holding us to ransom to conform to their demands, but they also hold us to ransom when they fail, demanding they're bailed out, or things will be much worse. They've got us both ways by, how shall I say it, the short and curlies. But if we, the people who produce the wealth of society, actually controlled that production and controlled the money that production makes, then the financial markets will no longer be able to hold us to ransom because we'll control that money. It won't swash around trying to make profits for the people already super rich. But that means no half measures, comrades. Ultimately it means if we are to stop these needless crises, we need a socialist revolution where the direct producers themselves take control of production to meet the needs of the many rather than the profits of the few.